Nice. Oh. All right. All right. Let's do this. 9 o'clock. Good morning, everyone. Today is Friday the 10th, November 10th, 2023. We have an exciting market pulse for you today. And our main topic today is actually around real estate. So we're going to be doing our real estate Friday forecast. And we have a lot going on in the real estate market. So if you are someone who is renting, someone who owns a home, someone who's potentially selling a home, someone who is potentially buying a home, or anyone who has anything to do with the real estate industry, you are not going to want to miss this podcast today because I am doing a deep dive into multiple data points that will give you a very clear window on what's going on next week, or excuse me, what's going on in 2024, and also to kind of get you set up on like whether you're buying, selling, renting, in the market, an investor, you'll be able to take some of this data and hopefully apply it, do some more research so that you are not caught off guard into 2024. So let me just give you an interview or a overview of exactly what it is we're going to be going over. So one of the things we're going to be talking about outside of our typical trades that we do on this podcast is we're going to talk about how overcooked the real estate market currently is in specific cities. And we're going to be talking about specifically San Francisco at some point with the CRE market. This NAR lawsuit, I don't know how many of you guys heard about this, but the NRA filed a $1.8 billion lawsuit against the National Association of Realtors and won. And in the state of Missouri, agents, brokers, etc., will have to give back part of those commissions to home buyers and sellers. So this is the beginning of they're saying it's $100 billion play. Anyways, we'll talk about that. We're going to talk about unemployment rate as that's going to play largely into interest rates. We're going to talk about inflation, where rates are currently sitting. And then we'll go into my favorite part, which is the data I get, where we look at all the data charts and points for the U.S. real estate market. And in those charts, you'll be able to see very clearly a very different picture than the news and the media is playing. We are not in a great place in real estate today, and I'm going to show you why. But before we do, guys, let's get started. I'm going to play our disclosure here, and we'll kick it off after that. So thanks for being on with us today. And there's our lovely disclosure to keep our attorneys happy. Obviously, guys, subscribe, like, follow, depending on what platform you're on. I'm streaming live on multiple platforms right now. If you're not following me on my YouTube live channel and you're missing the visuals, obviously hop onto our YouTube live. But we are going to kick this off. And the way we're going to start today is talking about how overcooked cities in the real estate market are. And so I want to bring up a visual just to kind of start this on a strong point. And so let's just bring this up really quickly. I think you guys are going to like this. Let's see here. I've got it here. There it is. So I think you guys should be able to see this. Let me make sure. There we go. So here is the top cities in the US ranked 1 to 20 that are overcooked. And this has to do with income versus buying P&I. So and it kind of makes sense. When you see some of these cities, you're going to be like, yeah, that makes sense. Like Hawaii. It's like, yeah, it's the cost of living versus the cost of real estate. It's like, it's impossible to live out there. It's really expensive. San Francisco, which we're going to be talking about later today, that's a topic I don't think most people are illusioned by, right? It's like, oh yeah, I knew San Francisco's market was kind of overcooked. I've been hearing about it somewhat on the news. If you haven't, by the way, this is the update. Then we've got another city in Hawaii, San Bernardino, Riverside, California. That's actually my old hometown. I hope that's not a sign of where I move. The markets get overcooked, but yep, used to live in that area, so I know that area really well. That's actually pretty surprising. But in the last crash, I remember in California, Riverside was one of the top crashing markets, meaning they had one of the highest climbs and one of the strongest falls during the 2008 crash. San Jose, Sacramento, Seattle, Greeley, Colorado. Now, here's the interesting ones, and this hits home for us. We've got Boise, Idaho, which is just above Salt Lake, Utah. And then we have Salt Lake City, both listed at about 48.8%. And so there's a lot of these unique cities like Greeley, Colorado, Boise, Salt Lake, that frankly were cities targeted mostly during the pandemic when people were trying to flee with their families to go somewhere that was safer, somewhere they could have their kids actually go to school. Maybe there's some city issues or crime issues where they're living. They tended to flee to these more suburban cities. And Salt Lake, I would say, is one of them, with only a population under 2 million. The whole state of Utah is under 4 million. So you kind of get an idea when you're coming from LA, where the entire city is 3 million by itself. The metropolitan area is almost 15, right? And so radically different demographic. And I think what happened is during COVID, these people started moving to these areas like Greeley, Boise, Salt Lake, and it caused the prices to inflate. And not to mention, most of the places these people were fleeing from, their home values were insane. To spend $1 million for a house was not a big deal. To move to Salt Lake or Colorado or Idaho and get twice the square footage for literally the same price, people weren't even blinking at it. And so it clearly drove up these markets. And I can tell you, living in Salt Lake, we felt the effects of that. And because of that, we're also seeing probably one of the largest drops. Phoenix, Arizona, also on the lower part of this list, and parts of Florida as well. So it's not surprising to see the overcooked areas and also the areas we're seeing the most price drops correlated, right? And so typically you're going to see that correlation. And so if you're looking to buy in any of these cities, you might want to think twice, because it's likely that they're overcooked for whatever reasons, maybe pandemic, COVID reasons, and you might see some price drops recent or sooner than later in these areas. I would also say the same thing for rents. If you're renting in any of these cities and you see one of your cities on here, I would definitely factor in rent declines. We are seeing rent declines also in the valley here in Utah. And I would say that that's probably happening on all these places as well. So if you've got a place that did a rent hike on you within the last 12 months, you're on this city, you probably need to be looking for a rent decrease in the next year or move to somewhere who's already adjusted their prices. And we're just not in the same climate anymore where it was impossible to find rentals, impossible to find a home to buy. The market has definitely cooled down. And so it might feel a little weird. Also, you might feel a little anxious letting your rental go or, looking for a new house to buy. It's a lot slower than it was a year, 2 years ago. So that's an interesting data point. The reason I bring that up is it brings us into our next point, and I want to share this just really quick clip from Jerome Powell. This is a video. Oops, we don't want to do that. But this is a video from Jerome Powell that I think he was asked a question from the audience after he went live. This is not a typical thing that someone from the Federal Reserve is positioned to say. But he did. And I think it's quite revealing of what some of the people in the Federal Reserve are actually thinking right now in terms of what rates and where rates are going. So just listen into what Jerome Powell has to say here. This is just a quick 30-second clip that I ended up posting on a bunch of my socials.
If you raise interest rates, you do see those effects, and you see those effects in the economy now. You see what's happening in the housing market. You're seeing that now. You'll see. If you look at surveys of people, it's not a good time, they think, to buy durable goods of various kinds because rates are so high.
And when he says durable goods, he's not just talking about like cars and assets. He's talking about homes. And then he kind of hints to that, even though you can kind of hear in his tone, he's backpedaling a little bit when he says it. But listen to what he says next.
Now, I mentioned again, we're getting reports from housing that the effects of this could be quite significant. I mentioned again, we're getting reports from housing that the effects of this could be quite significant.
You guys have to listen to the words that come from the Federal Reserve, and the reason people hinge on these words is because there's an old saying in trading, in buying any type of asset class, that if you're going to trade inside the markets, the number one rule outside of trade the trend and let your profits run and cut your losses short, outside of all those rules, the top rule, if you're in a country where you're dealing with a fiat currency, is do not fight the feds. Jerome Powell is literally the face of the feds. He reflects the chair. He reflects the board and the votes of the entire Fed room. And so when he speaks about what's going to be happening in the real estate market, he is prepping the market. You have to remember that we were prepping the market for rate hikes 2 sessions or 2 periods before we even did it. The Federal Reserve would warn that they were going to give a warning. Like, they were constantly prepping the public. They're not doing this to like throw a head fake. They're doing this to actually get the market to adjust and to be ready for when this happens. So if you're in real estate, it's like, pay attention. Jerome Powell is saying the housing market is cooling. He is saying we're going to see in the future, he's saying a future tense, a correction in the market, not something that he's seeing right now. And so the data is coming in clear, and I'm going to show you all the data points I have on why I completely agree with Jerome Powell. The housing market is cooling and there's going to be correction. We're already seeing it. We're already seeing correction in states like Utah and states like California, Arizona, Florida. So it's already happening. And depending where you are in the country, you want to be keeping an eye on this also, because fighting the feds is the worst plan. It's like a guaranteed losing proposition, because the Federal Reserve using interest rates as one of their major levers can literally manipulate the market, can literally through M2 constrict or expand basically any financial market. And the way they do that's with rates. And I'm going to kind of tie all these little pieces together. So here's a fun thing, though. I want to show you this interest rate hikes chart. This is going to tie in perfectly with this. So just take a look at this really quick. Let's see if we can bring this over. Hold on just a sec, guys. So this is just an interest rate chart. And I think I'm going to bring up two different charts, actually. These two, I think, are quite revealing, because once you get a sense of where we are with rate hikes year over year, you'll start to get a sense of like, okay, if I were the Federal Reserve, knowing what's happening in the market, what would be my next play? And what is good data? What's bad data? And a lot of people don't understand that. So this chart, just bringing this back up, is the interest rate chart. So this shows interest rates, or excuse me, this shows inflation month over month, year over year since 2000. And you can see back in 2000, we had rates at about 3.4. Right now we're at, inflation at 3.4. Right now we're at inflation of around 3.7. And the target rate, inflation rate that we want to be at is between 2 and 2.5%. So we actually like for it to be around 2. The Federal Reserve's target is 2. And when it's at 2, we don't do rate hikes, we don't do rate drops. But when it goes below, when we start to see inflation drop below 2, you'll start to see rates drop, because we can add QE in, we can start to ease on the market. But if we start to see inflation go above 2, we're going to have to constrict the market a little bit to bring spending down. And at 3.7, guys, I just want you to look at this. July 2023, we were at the lowest point of the year at 3%. So 3% inflation. Then that was June. July, we went to 3.2. August, we went to 3.7. Guys, is inflation going up or down? I mean, I could ask my 10-year-old this, and he'd be able to answer this. It's not going down. Inflation has come up the last 2 months. Mind you, we did flatten a little bit in September. They're watching the data really close. That's why we did a rate pause. But when you take this data into consideration, everyone's saying, oh, well, we're going to have rate drops early next year. No, you're not. If we don't get inflation down, if it doesn't come down to that 2.5% target rate, you're not going to see rate drops. That does not happen. So don't fight the feds, guys. Use the data that the feds are using, understand where their target rates are. And from this, you can glean like, okay, when really are rates going to start dropping, which would be a good sign of the housing market picking up, or really all the markets picking up. And I'll tell you, guys like Warren Buffett, they understand this stuff. And there's a reason why they have the most cash reserves holdings that they've ever had in their portfolio right now. In fact, I should have brought that chart up, but we're doing real estate today. Let me show you one more chart. I just think this is valuable to see visually. This is inflation decisions by the feds. And this is Federal Reserve interest rate hikes month over month and what's happened since March 2022. So you can see we started bringing rates up in March 2022, quarter point, half a point, and then we had 4 3/4 rate hikes back to back. December, we had a half a point. February quarter point, March quarter point, May quarter point, June, we paused. And you can see why when you go back to that chart. Remember the chart I showed you? June was 3% inflation, but then July it went up. And so what did we do in July? We brought rates up. And then remember September? September went sideways, so we paused. November, we're pausing. And the reason is we have some other data in unemployment that is going up. So although inflation is kind of up a little and sideways, we have some other data points that the feds are looking at, which is unemployment, which we're going to get to, which is playing a huge role in the Fed's decision of whether they should bring hikes up or not. And so I'm just going to show you this really quick. This is the current unemployment chart. And this is going to tie this whole picture together, guys. I try to make this as simple as possible for you. Let's see if I can bring this up. Here is the unemployment rate chart. And I'm just going to bring this into a 1 year so you can see it better. But currently we are at 3.9%. This was actually higher than expected. So there's all these forecasters that like put out the numbers, what they think they're going to be. October's number came in and it was higher than expected. And so from 3.8 to 3.9, unemployment is a way that you'll actually see market contraction, because as people get unemployed or people start hearing about people unemployed, they start holding on to their cash more and they stop spending as much. And literally, if you don't have a job or you're only getting unemployment benefits, you have less money to use. And so it does contract the market. This is the data point that the feds, it sounds crazy and you may not like hearing this, but this is the data the feds like to see. We want to see unemployment, guys, between 4 and 6%. Now, I know, put all this together. The feds want higher unemployment to stabilize the economy. So right now we have too low in unemployment, and that's what's causing inflation, too many jobs. I know that sounds awful, but that's the truth. And then we have inflation that's ticked up a little bit and going sideways. So that's why we saw the rate pause, is because although there was a little inflation, unemployment's going up. So they're thinking next month, this is going to balance out. GDP is probably going to drop. Consumer spending is probably going to drop. And we're probably going to have a pretty rough Christmas, meaning we'll probably have one of the lower Christmases over the last 5 years, meaning less spending over a holiday season than we've probably, my guess would be in prediction would be over the last 5 years. Again, not financial advice, guys, but just something to consider and to look at in terms of data when you're making your trades or investing in the near future. So how does this all piece together? Long story short, higher longer is the consensus. And what I mean by that is I would expect, based on just the data that I've shown you, that we're going to have interest rates at least where we're at for a longer period than we thought before we see a price drop. And I see these real estate agents and I see these brokers who clearly have a cognitive bias and are really trying to will the market into a rate drop. But the reality is that's not going to happen anytime soon. The data does not support a rate drop. If anything, we will go sideways for a while until we see unemployment really tick back up into that 4 to 6% range. And we see inflation at a minimum, at least stabilize, right? So until that happens, guys, higher, longer. Now, that doesn't mean we're going to see another rate increase. We could. I think that's plausible. It might be into early next year. However, I think just pause, sideways, longer. And what does that do to the markets? Well, you're going to see the bond market get affected by that. You're going to see longer term bonds go up in rates for longer periods of time. You're going to see money market accounts giving more for longer. You're going to see your mortgage, your 15, 20, 30-year mortgage rates probably go up a quarter point. And so the longer that this stays sideways, the long-term market adjusts also, which it contracts the market. Because if you know you're going to have a 15, 30-year mortgage rate that's at like 6, 7, 8% versus some lower rate because everyone's, kind of calculating in rate drops, the market's going to constrict. It's going to contract based on that data. So There you go. There's the Fed consensus on rates and what's going to be happening in the market. Now, I have some other really fun news about the real estate market. And you've got to see this because if you're in real estate or interested in it at all, the NRA lawsuit is probably one of the biggest topics that has broke in the last 7 days. And if you haven't heard this, the news is not covering this very well. And it's because the attorney, I'm going to show you this interview, the attorney who filed and won and got a $1.8 billion verdict went on CNBC and it did not go well. I think they brought on the National Association of Realtors. They literally, I think, brought them on to try to like make this story sound better, to make sure this wasn't a domino effect that happens throughout the rest of the country. I can tell you, based on this interview and what I'm seeing, this is going to happen in every major city in every state. And so buckle up, guys. We're talking over $100 billion in recourses from what they're calling a Ponzi. They're calling a cartel. They're calling these brokers and these associations part of a cartel for nickel and diming the buyers and sellers of these homes. And they're actually looking for recourse, and they just won in the state of Missouri. So let's bring up this interview. It's going to blow your mind. I mean, what's happening in the real estate market, this change will shift how we buy and sell homes forever. And companies, here's a little plug, I'm not getting paid for this, but companies like Homey, where you don't have the buyer seller fees as high, where you're not paying 6% to get a deal done, businesses like that are going to be the future of real estate. And having a buyer seller agent who's getting paid 2% for closing a deal, those days are over. So if you are a real estate agent, a real estate broker, it is time to pay attention. It's time to possibly adjust what your game plan is going forward, because the days of getting 2% kickbacks on your sales are over. The days of getting a 2% kick for being a listing agent are over. So here it is.
All right, so what does the ruling mean for the industry at large and maybe what you pay for a home? Where do we go from here? Joining us now on set is Bess Friedman. She is the CEO of Brown Harris Stevens and a member of the National Association of Realtors, and Michael Ketchmark, the lead attorney of that lawsuit representing 500,000 homeowners in Missouri. Bess and Michael, thank you for joining us here. First to you, Michael, what is big settlement here, 1.8, or verdict, I should say, $1.8 billion. First up, where does that money go? Is money going to be kicked back to people who bought homes, or where?
Sure. I mean, we view it as a day of accountability. And I told the jury, this case is simple. It comes down to premises I learned when I was in kindergarten. If you take something that doesn't belong to you, you give it back. The money will be returned to the homeowners that were the victims of this rigged system. It's been going on in our country for about 100 years, and it stops today. And we're going to hold these corporate real estate companies and National Association of Realtors accountable for their conduct.
And I understand you are ready or have already filed more lawsuits.
Yeah, the day that the minute that verdict came in, we filed the lawsuit against the National Association of Realtors and these other large corporate real estate companies to bring the same relief nationwide. And we expect the damages in those cases to be in excess of $100 billion. And
$100 billion, guys. This is insane. Like this, and I don't have really a fight in this battle. I'm not an agent. I've never made a commission off of a real estate transaction. So I really don't have a fight in this battle, but this is reality. And from an outsider looking in, if I was a real estate agent right now, I would be looking at this as the death of my career. It'd be like looking at AI and being a newspaper article writer, or trying to get a job in like something that has to do with writing. It's like, are there still going to be jobs? Absolutely. But how many? Probably about a tenth. And so when you cut the commissions, and I would imagine what's going to happen is this will cut commissions by probably at least 60, 70, 80%. The amount of work an individual will have to do, they'll have to do 5, 10 times the volume to make as much as they were before. And frankly, I during the last real estate boom, a lot of these agents it doesn't take an insane college degree. It doesn't take a lot of education to go out there and just hustle to create a lot of money. And I think that's what the industry has realized. And I thought this was just something that was hypothetical and, we were just talking about. No, there was a verdict that has come in on this now. Damages have been awarded. Homeowners are going to get a part of this $1.8 billion in the state of Missouri. I think you said 500,000 homeowners. And now they're filing lawsuits all across the country. And they say the damages are in excess of $100 billion. So we're going to see a massive change going forward in the real estate market, not just from prices, not just from the softening and interest rates, inflation, blah, blah, blah. We're going to see it from basically how we even buy and sell homes. And I know I didn't actually bring up an article on this, but I think it's noteworthy to bring up. But Fannie Mae also just this week announced, and this is news for anyone purchasing a multifamily unit home. If you buy a multifamily unit home, Fannie Mae has just dropped the down payment requirement to 5%. Now, 5% is extremely significant because typically and you have to live in it, by the way. So you have to occupy and be buying a multifamily unit. But a 5% is sometimes 4 times less than your typical down payment. And so right now, if you find, you'd have to find the deals, right? You'd have to find somewhere that, is cash flowing. It would make sense to go into the property based on rents and how much your interest rate and payment would be. But if it made sense for you to live there and for you to cash flow on the property, right now you can do it with as little as 5% down. And I think they're trying to do this to incentivize the multifamily unit development from more of a not an institutional side, but more of a retail side for like guys like you and me. We could go in and rather than buying our first home, maybe what we do is we buy a multiplex, we buy a fourplex, we put ourselves in it because I got to live somewhere anyways. And the other 3 we used to try to at least break even. And now I'm getting the equity value of the complex. So let's move on to our next topic. That was a fun one, right? The NRA lawsuit. Oh my gosh, guys, what is this going to look like in 5 years? Really. And our companies, by the way, something like this, are companies like Homey positioned well? And is there a trade there? I would say absolutely. There's definitely a trade there. We talked about, oh my gosh, let's go through this. This is going to blow your mind. So we're going to take a little bit of a transition down the CRE street, CRE being the commercial real estate sector of the real estate market. And I'm going to bring up I just put this together really quick. It was a Word document of a bunch of listings that I found. And this is going to blow your mind. Right now in San Francisco, to give you an idea of what's going on, and I'm going to talk about this while I'm also showing it. This is a building on First Harris Street. It's a 200,000 square foot building, 200,000 square feet, guys. It had a year lease back with Gap, but now it's vacant. And a company called Sobrato purchased this in February for $82.5 million. And a lot of you might think, well, that's not a big deal, Matt. Like, what's going on with that? Well, that is a massive discount in the state of California, specifically the city of San Francisco. And while I'm showing you this, I just want to give you an idea of like what's going on in San Francisco. I don't know if you've traveled there recently, but the last time I was there, it is a zombie apocalypse. A lot of people are saying San Francisco is similar or like to a modern day Gotham City, that we currently have a DA and a bunch of judges and a mayor in San Francisco that has gone so extreme left. And I'm not saying, I'm pretty down the middle central on a lot of topics. So I'm not trying to be political here, but there's something that happened about going so extreme left that they're impoverishing the city, and the drug and mental health and violence is escalating on a level in the city that it's never seen before. And you combine that with the pandemic, COVID, sending all these tech jobs home. And now they're in a very unique position looking forward, going, one, do we need to bring everyone back? Two, can we afford to keep everyone? A lot of these tech companies are downsizing. And three, does it make sense for us to be in this city after this anyways? Should we just reposition and move somewhere that's going to be cheaper? And so the San Francisco Bay Area is going through kind of a new paradigm, a sea change, you could say, when it comes to commercial real estate, because the pandemic virtually moved out 50% of tenants. And that is not an exaggeration. In fact, there's a chart that I don't have for today, but there's a chart that actually shows where we are after COVID in terms of people going back into buildings. And there's a chart that shows how many, what percentage of people are actually moving back into their buildings, and they're doing it based on tenant data. And nationwide, surveyed over, I think, 2,800 different cities, we are only at 50%. So only 50% of the workforce that left has gone back into work, like into a physical building or the building they were working at before. So we, in a way, have had a paradigm shift around how to work, the work from home dynamics. Have a lot of them come back. Yeah, 50% of them went back. So there's a lot of industry that's done that. But if you are a business owner and you're scratching your head going, okay, my cost per square foot is 4 times what it could be if I moved to Utah, or if I moved to Colorado or Idaho, or I could just leave people home and not have this commercial real estate expense at all. I think I'm going to do that. Or I think I'm going to do less actual commercial building space and more stay at home. And so this is something that's happening, and you're seeing it in the commercial real estate prices and listings. But this is just one example. Let me show you how severe this is, guys. This is not just something I put together and I was like, I found one anomaly. The San Francisco market could be one of the most rich commercial real estate opportunities if the DA and the judges and the mayor get their act together and they start cleaning up the city. This could be maybe one of the best positionings you could put yourself into in terms of a real estate area or sector. And this would be a long play. We're talking 5 or 10 years is how long it takes to typically clean something like this up to draw people back into a major city or metropolitan area. But look at this. 60 Spear Street. These are all San Francisco buildings I'm going to be showing you. 168,000 square feet, only 37% occupied, was purchased in 2000. Let's see. It was purchased this August for $41 million, which is a 62% discount from 2014. All right, well, there's one. How about this one at North Park? 293 square feet, almost 60% occupied. Blackstone purchased it in 2018 for $245 million. It's now under contract to be sold back at $82 million. That is a 67% discount. You can't make this stuff up, guys. Oh, wait, how about this one? 180 Howard Street, 243 square feet, 32% occupied. Here's the drop. They dropped the deal and now it's supposedly under contract for $62 million. Guys, here's another one. 123 Townsend Street, 138 square feet, 73% occupied. Rubicon purchased it in October for $72 million, which is a 49% discount from what was paid in 2020, July of 2020. Check this one out, 600 Townsend Street. These are smaller buildings. So it's not just like these huge buildings. It's an array of different buildings. 87,000 square feet, 2012, sold for $47 million. Today, sold for, or in September, just now sold for $25 million, which is a 47% discount. How about 550 California Street, 355,000 square feet, 62% less than what Wells Fargo paid in 2005, a $40 million purchase, which was 62% less than, guys, this is pre-pandemic, pre-2008 crash. This is lower than the crash in 2008. So there's something bizarre going on. This is definitely very acute. This is a very acute situation happening in the Bay Area. So there's a lot of things compounding happening specifically in the city, but this is also a sign of what's happening in the CRE market. And wait till we get to my main point, and that's what's going to happen to the people who have this debt. What's going to happen to the banks that have to swallow this 62% discount on millions and millions of dollars? Here's another one. 115 Sansum, 125,000 square feet, 56% occupied. Asking price was 25 million, which is a 70% discount from the purchase price in 2016, guys. I mean, I don't know how the Bay is going to recover from this. They're going to have to start raising taxes to make up for the lack of business in the city. And unless they make some radical reforms, business is not coming back until they do that, which may make it a massive opportunity. Here's another one, 201 Spear, 75% occupied, was purchased in 2013 for 121 million and is now listed for $73 million, which is a 39% discount. Guys, and the list just keeps going on and on and on and on. So there you go. There's the Bay in a nutshell. But here's what I want to talk to you about before we move on. So one of the things that fascinates me about CREs, the reasons I'm watching it, is I'm targeting banks right now. In fact, if you look at my list of stocks, like my hot list of things that I check probably every week, I'm looking at banks. I'm looking at what's the price of banks, what's the PE ratio for banks, and more importantly, how are their CRE holdings? And you can do your own research on this, guys, to figure this out. But there is an opportunity there, no question. CRE holdings are the commercial buildings, commercial loans that were given by these banks. And every bank's different, right? Like some banks are more hyper focused on like car, auto, short-term loans, maybe residential real estate, residential loans, and then some business and commercial loans, right? And based on the bank, there's a percentage allocation for every area. Well, some banks are much more heavily in the CRE department. Silicon Valley Bank, by the way, was one of those banks that was just heavily over leveraged on the CRE market. And there are others. And so what if, just putting this out there as a thought, there was a big bank play coming in and we get things stabilized and we hit the bottom of the real estate market and the CRE thing kind of clears out. And the banks who didn't have all that CRE exposure, like some of the banks that did, just from the news, the hype, the psychology, the price got suppressed, right? Because everyone thinks, well, it's all banks. Well, it's not all banks. There's some really smart banks out there that don't have the CRE exposure that other banks do. But the price of their stock dropped, within 90 to 80% of the other stocks. Well, is there going to be an opportunity at some point to buy those up and climb the ride back up? Absolutely. And so I'm watching bank stocks very closely because of the CRE market. And I'm trying to time that moment where it's like, okay, here's the exposure. They're going to have to refinance. You're going to see a lot of the giving the keys back to the bank happen. Who's going to be exposed the most? You don't want to get stuck, obviously, with a bank that's going to go bankrupt because that's a zero proposition for you. But what about the banks that aren't? And the old saying is you want to buy when there's blood in the streets, right? You want to buy when things are so bad and look so awful. So you want to be looking at management. You want to look at PE ratios. You want to be looking at their holdings, specifically the CRE holdings, because our government has already backed all their bond problems, all this mark-to-market stuff that we did. We already fixed that for the other banks that failed. And so that isn't going to be a problem going forward with new banks. All right, so let's move on. What else do we have here? That was a fun one, right? The CRE market. Oh my gosh, San Francisco. It's like, oh, wouldn't it be fun to own one of those buildings? But then when you travel down there, it's just such a tragedy. The Bay Area. I remember my dad growing up. He was doing these like sales presentations. And I remember him taking me actually to the Bay. We were downtown in the harbor. And I remember, the boss took him and a bunch of the sales guys to this nice seafood restaurant. And it was fun. It was light. There were, people doing acts and there was like a lot of art. a lot of theatrical musicians, people panhandling, but doing like talents and stuff on the streets. And it was really fun. It was really artistic. And as a kid, I remember it being really a highlight city for me. And to go back to it today, I mean, this was 30 years ago. To go back today and see what's happened over 30 years, it's a travesty. And I really hope, this is a wake-up call for the political leadership there, because the residents, you can't vote these kind of people in anymore and not expect your real estate values to drop. This is bad business for the city. And so you guys need to wake up out there and start voting in people who are going to turn this stuff around, fixing crime rates, fixing the homelessness problem, and more importantly, coming up with good policies to drive business back to the city. All right. What else we got on here? Inflation, unemployment. All right, let's go into my US chart, and then I'm going to do my trades here at the end for my people who like watching gold and the S&P 500. But let's go ahead. We are at the point where I get to show you my charts, and I'm going to bring this up visually for you. Let's see if I can find this. Got so many things up here. So what I'm going to do is one of the unique things that I get that I share to the public for free is a sheet that I created where I get the national data about a week before all the major news outlets. And now, I mean, obviously, because I'm sharing this, they have access to this also. But these charts come out live before typically you even see a news release on this. And so I'm going to bring this up. You guys can scan this if you'd like. But here it is. Let me close some of this stuff up. This is our Market Pulse US real estate data chart. And you can scan this QR box on the top with your phone and save this link to your computer. And I update this live right around the second or third day of every month. So this data actually came in about 7 days ago. So it's hot off the press. And let me tell you what we're looking at. For those of you who don't like nerding out, you don't like looking at charts, that's fine. I'm going to try to make this as fun as I can for you. The charts we're looking at are really kind of an insider's information of what's happening in the real estate market, because the news has a bias. People who get on the news have a bias, right? The one I made fun of the most was this Barbara Corcoran interview that happened where she made fun of Elon Musk, because Elon Musk was like, oh, the housing market's going to cool off, be prepared for a potential sideways and softening. And she got on the news and was like, well, Elon, he's so cocky, blah, blah, blah. I'm in real estate. I know better. Yeah, the commercial real estate's going to get hurt, but residential's fine. And it's like, well, Barbara, foot to mouth, it's not going fine. And the data is showing reality. So opinions versus data wins every time, guys. And that's why I like to show you this, because I can show you the data and you can draw your own conclusions. I'm going to help you with some of those, but you could take all my language, everything that I say about this, throw it out the window, draw your own conclusions just based on the data points. And I think it's pretty revealing. So let's jump right in. So this is median list price, and this is national. So this is all the national data. As we talked about, certain states are way worse and some are way better than others. We're not going to go into those states today, but this is median listing price nationally. And you can see very clear, this is not above the all-time high of this year. It's also not above the all-time high of last year. In fact, you can tell if you know how to read a chart, the high of this year was lower than the high of last year, and we are coming off. So what is this called if you're a trader, if you're an investor? Well, we call this a new trend. When you come off the high, and now you have a new low high, you are in a new trend. And so to say that we are in the same pattern and trend of this like climbing market isn't true. And all the stuff that we talked about with the Federal Reserve, interest rates, inflation, yada, yada, that's playing into this. And so you can clearly see data came in October 1st, median price at 425. The last month it was 429. So we have seen a drop in the median listing price. Now, what about the average listing price? Well, median and average are similar, but not the same. We are at 745. The month before, we were at 749,000. So we saw a drop from that also. We're also off the all-time high. And this is average listing prices. So this is telling a very grim story. And some of this is seasonal, right? You can see the seasonal up and downs from like summer, spring to winter. We always see a drop after the spring and the summer. Now, this is price increase count. This is how many houses we're seeing a price increase anywhere nationally, the number of homes that had a price increase. And you can see that that number is significantly dropping. We're having less than 20,000 price increases. This was happening a lot during the pandemic, where people were like, oh my gosh, my house is worth more. And they would like start bringing the price up. That is not happening. That is not the picture. We are at an all-time low way, way back before 2018. Price increases are a thing of the past. We are turning into more of a buyer's market. This is a sign of the end of a seller's market. Price reduction count. Price reductions are going back into an all-time high. So price reductions went up all year. We're probably going to go into, well, here's the thing about price reductions also. When you have a bunch of price reductions happen before, they've already reduced the price. And so we're starting to get used to this new lower price listing amount. And so realtors have their heads screwed on a little bit better than they did during the pandemic. And they're saying, you know, to be real, if you need to get your house sold in the next 60, 90 days, you can't list at that high price. And so we're not seeing a lot of outlandish prices being listed, as you saw with the average listing prices. They're not throwing them out really high anymore. So they don't have to bring the prices down. But if you go on a listing site, you'll see price reductions almost on 50% of the listings, at least here in Utah. And I don't know if that's a strategy where they're just like, they drop it 10,000 because no one's looking at anything unless there's a price reduction, right? It's kind of like, I feel like I'm getting a good deal. There's a sale on this house. But we're seeing less of it, and we are seeing an increase in reductions overall, specifically from the last month. Now, median listing price, similar as the last data. So this is where we're coming out as median listing price, but this is with the square footage. So what we're getting here is less square footage now based on the listing price. So now what's happening? The median listing prices are coming down, but we're also seeing that people are getting less per square foot. And that's what this is showing. We are getting less per square foot now than we did off the high of last year and the high of this year. Pending ratio, I like this chart because this is the active versus pending listings. This gives you an idea of how many homes are under contract, how many are pending the sale versus the ones that are active. And so when you get to 0, that means that there are less pending than coming up new and active. And so we are clearly dropping into this level. Obviously, this high area was the pandemic, when there was just, you know, homes were selling left and right, and there just wasn't enough inventory to make up for it. That is clearly coming back into the normal realms. We like this, though, to be below the 0.5% level, the 0.5 level. And that's more normal territory in terms of supply and demand. But with rates as high as they are, you got to remember, this is when there were low rates. With rates as high as they are and going below the 0.5 level, this is where you, again, see more softening in the market. Let's go into new listing count. Now, this is the unique piece of data, and this is what everyone's talking about when the real estate agents will get on and be like, oh, no, the market's going to go up like crazy, blah, blah, this and that. And it's like, this is the one data point that they have in their favor, and it's new listing count. New listings did spike this year. We're kind of back in that 400,000 range. We did drop below it, and so we are kind of in these new historic low inventories. However, how long they're staying on the market is much longer because rates are higher. And that is shown here in active listings. So check this out. New listings is lower, but active listings is climbing to a 3-year high, guys. How does that happen? Well, it's very simple. Just because you don't have a bunch of new listings coming in every month, the ones that are already listed are staying on the market much longer. So days on market is going through the roof. And we'll get to that chart here just in a minute. So total listing count starting to come back up into the normal territory. We're above a 3-year period. We're definitely not in the all-time highs. This is, again, one of those data points that realtors are using that's saying, hey, the prices are going to go up, blah, blah, blah. And it's like, no, it'll only happen when rates start to drop. You guys heard my consensus on what I think the Feds are going to do higher, longer. That's going to put more strain on the real estate market, not less. Then we have pending listing counts dropping back into pre-pandemic levels at high interest rates. So the amount of homes under contract is dropping. That's why that pending ratio is also getting into kind of that dangerous territory. The median square foot is also dropping. It went to an all-time low in 2022, and that was because the cost, people were paying a ton of money for less square footage. We went into basically almost a year and a half of getting more bang for your buck. And this is a seasonal move, right? This is a seasonal drop. As you can see during pre-pandemic, these drops typically happen faster. This is a slower drop, and the last drop was slower also. So I think this is a trend that we're going to actually see go up and probably go into a new plane that we haven't experienced before. And then last but not least, median days on market. This shows that we are seeing much longer listings. It's harder to get your house off the line than it used to be over the last 3 years. So the days of like putting up your house and getting it sold really quick are over. You now have to price your house at a reasonable price to get it to move within a reasonable amount of time. And it's not going to look anything like the last 3 years. Does that mean that you can't sell your house right now and it's not going to sell within a reasonable amount of time? No, it definitely will. We're still in a pretty warm market in terms of moving the house and getting, a lot of equity out of your house when you do it. Are you going to see prices back during the pandemic? No, those days are over. You're not going to get what your neighbor sold their house for a year ago because the market has shifted. Will you get more than you bought it for 5 years ago? Very, very likely. It's obviously going to depend on your state. All right, so that wraps up our real estate corner. I've got to jump in for my traders and investors who love me doing this market analysis on gold and the S&P 500. I'm going to do a victory lap. We'll call it a modest victory lap. I'm going to do a modest victory lap. It's kind of a funny thing to say. I don't know if that's possible. It's like, I'm going to do a modest donut in the parking lot. It's like, okay. I think it's fine to brag. It's fine to brag when the thing you're good at, you're good at, and you have evidence to back it up. And what I'm showing you, especially for my listeners who can't see this, what I'm showing right now is a gold chart. And gold right now is trading at $1,900 and 30, so 1939. So 1939 is the price today. Last week when we did this Friday, it was at 1990. So it has dropped, about $50 an ounce. And you can see on my chart visually, this is much easier to see. So if you're following me on YouTube Live, you can see this. If you're following me on a webinar, you can see this. If you watch this tomorrow on any of my podcasts, you can see this. But for my listeners, what you're seeing is we were right at the 2000 level. There's something about gold going over 2000 that there's just a lot of psychological resistance. Meaning it wants to push the price down. And we were talking about this Friday, like 2000 is going to be a really tough price to go over. But once it does, it's going to want to stay over it forever. Like once we finally get over that price, and like there's just so much inflation that's happened that like 2000 just the price we never come back to, it's going to do that. And so what I did is I showed based on where the price was, if we went over 2000, there would be a trade, but it was highly unlikely. If we saw the price come down, we said, look, I kind of drew the circle sideways of Friday and said, look, it's very likely Monday and Tuesday, we're going to see some movement sideways into the market because we're right up against that $2,000 resistance level. And then I said, it's probably going to come down to this 1973 level, which will act as support. And sure enough, on Tuesday, it hit it and really bounced on this. And then we had the break. And you guys can see in my drawing, I said, if it breaks below 1973, we are in a new trend. This thing is dropping, and it's going to likely drop into the 1882 levels. And so if you're looking to buy gold, physically or in the market, there's probably some room to go into next week. I'm going to draw some tools really quick here to get us started on this, but let me just kind of set up where we're at in this new trend. And I'm going to draw a couple here because we might actually be in one that's like this also. So we have two different trends on gold right now, and they're both down. They're both bearish. And I'm going to get rid of some of these drawing tools that I have on here so that we can see this a little bit better. But we are in two different trends, one that goes 2 weeks back, one that goes a week back, and they're going towards the 1882 level. Now, what do I see when this happens? Well, we're either going to get some news next week that's going to cause this to bounce back up into the 1973 levels. However, with this short trend, my first rule is don't fight the Feds. Second rule is trade the trend. And so if I were to guess where this was going to go based on 15 years of doing this, we're going to have probably a high probability of the price going in. Let me just draw a circle really quick here. Into this level where both of the trends connect, meaning there's a high probability we're going to see price here because they both intersect here. And we're also probably going to see some breakouts. And it's either going to be a breakout. Let me draw this here. It's going to be a breakout to the upside, either after this short trend or this one. So I'm going to kind of draw this out here. And then we're going to have another one that could be towards the downside, which is, I think, more likely. And then a bounce off of 1882. So if I were placing a trade, we're kind of in the middle. We're in this no man's land, right? We're between a strong resistance point at 1973, strong support at 1882. We're kind of right at the middle at 1939, but we're not directly in the middle. So if I were looking at this, bearish would be my direction, a short trade. I'd be putting my stop losses outside of the 1973 level. So I'd be above that level so the price doesn't hit it. But if we get a breakout, like let's say Tuesday, Wednesday, or Thursday to the upside, it breaks this channel to the upside, I wouldn't want to take my take profit anywhere beyond probably somewhere close to like 1967, because you don't want to get too close to this resistance level. And then you would set your stops below the 1876. So guys, I mean, I'm not Houdini, but I'm kind of Houdini. I've been doing this a long time. This is our gold setup for the next week. And just like we predicted last Friday, I imagine this is where it's going to go. We're going to see bearish pressure. This is an unlikely move unless something fundamental happens, like inflation data shows going up, or something shows market recession, or we see a massive drop in the stock market. You might see gold tick up based off that data. Now, let me show you the S&P 500. Now, I know a lot of you, if you're seeing this for the first time, you're going, how in the world do you do this, Matt? Like, you literally picked the market. And it's like, no, I've just been doing this for so long. Once you understand technicals, you understand market cap and how prices settle on these lines. Traders put all these limit orders within these levels, and all these strategies are literally using indicators that are based on price that are, buying and selling within these larger data sets. It becomes very easy to predict what's going to happen within reason, within a technical scope. Now, something fundamentally can just kick this off the rails, right? Something fundamentally being the news, an announcement, nuclear bomb goes off, something like that. It doesn't have to be that extreme, but that's what would, this won't follow that when something like that happens. But for the most part, you can predict your technicals. And even when something fundamentally happens, it's going to test those technicals still. So here's what happened. Last Friday, you can see the line. I'm going to zoom in. S&P 500 Friday was at right around 4,332. Right now, it's at 4,379. So it's gone up. And we were saying that. We were saying, look, we've got this long-term short trend that goes way back to July of this year. So I've got this trend going down all the way from July, and we are still in that trend. Don't let anyone confuse you. Look at the trend, guys. We are in this. We're getting up to the top of it, so we're definitely creating pressure towards a breakout of this trend, but we are still in this short trend. And then what happened? Over the last 2 weeks, we were in this uptrend, a very tight, fast uptrend, all the way from 4,100. The climb went to 4,300. And so we saw this, but what was happening is this downward pressure. We have this long trend, right, over the last couple months going down, coming up against an uptrend that's short term. And so there's going to be pressure. And who's going to win typically? Well, typically the longer trends outbeat the short trends, and then something fundamentally often will kick it out or will break the support and the resistance. So what did we do Friday? We said, well, it's very unlikely that it's going to come down. In fact, I didn't even draw any type of trade below the 4,332 level because it just didn't seem feasible. It seemed like we're going to have this pressure. Now it's going to start testing the top of this support, or excuse me, this resistance level of this channel. And sure enough, what did it do? 1, 2, 3, 4, 5 days of sideways movement, exactly like we predicted. So you could have done a lot of scalping in this. You would have obviously put your stop losses outside of these resistance levels. So now what? What's the prediction for today? Well, if I were looking at this, it's a lot worse than it was last week. This is a much harder time period to predict than last week, and I'll tell you why. We're in this downtrend, and it's still extending, but it's going to get tighter, and we're out of this old trend, this uptrend that happened over the last 2 weeks. That's done. So now we're kind of in this new downtrend, and we're going to have this pressure that's going to build towards the upside as we get close to this 43.32 level. But we're also going to have this down pressure from the top of this channel. And so I'm still calling, based on the size of the candles, sideways pressure. However, a breakout to the upside is more feasible from a technical standpoint today than it was last week. So I'm just going to draw a very light candle, or a little light circle up here, so you guys get an idea what I'm talking about. But there's a very light chance of that. And it's more feasible today than it was last week to have a breakout in this channel, even though the price is very similar to where it was last Friday. We also have a light likelihood of it breaking to the downside. If it does this, it's going to break hard and wide. So it'll be wider and down. And then I would be setting my stops into like the halfway mark, this 42.66. So here are your trade options. You could put some limit orders in, and that would probably work. You could put some market orders in when you're watching this next week. But what I'm seeing is if we had a breakout below 43.22, it's likely going to go to at least the halfway point, 42.65. So you could short this into the 42.65 level, put your stop loss obviously above the 42 or the 43.32 level. So stop loss up here, take profit down here. I don't foresee that happening. And if it does, it's going to be later in the week, or it's going to be fundamentally based. There's going to be some announcement that kicks it down. I think we're going to see mostly sideways. This is great scalping territory. If we get a breakout to the upside, don't take a big trade. I do not foresee an upside breakout going that high. I do not see it testing this 43.73 level. My sentiment is more bullish next week than bearish. However, I just don't see it breaking this level within a week. So we'll have to wait and see. Again, sideways movement looks like the play again. And I would say be more cautious than not this week on the S&P 500. Gold, however, looks great. I like how gold's looking. I think we've got some solid trade setups kind of being out here in the middle and in a short trend. So there you go. Sorry, guys, I went over just a little bit, but I like to get those trades out. For those of you investing or are in the market, my S&P 500 kind of gives you a full market sentiment for the entire next week. And I'm not saying I've got a crystal ball, but I have been doing this long enough that doing this is relatively easy for me. And if you're not great at technical analysis, just hopping on here every week with me, week after week, will help you take this and apply it to anything. You can use this and the techniques and strategies that I use here on any stock, any market, anything that you're trading, to really target like, hey, is today the best day to buy? Is tomorrow the best day to buy? And so you can start positioning a little bit better, even if you're someone who buys and holds long term. It's like sometimes a couple days gets you that much better of a price And it's always better to be patient and have better pricing than it is to be lazy and to have to hold things longer than you want. All right, so that wraps it up for today, guys. Thanks so much for being on here. Again, Matthew Pohl, Market Pulse Podcast. You can catch me on my socials. You guys have a great weekend, and we'll see you same time, same place next week. And Friday next week, we will not be doing real estate, but we'll be going over stocks and other market factors that impact your trades and your investments. So thank you, and have a great week.